following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It is a dangerous world out there. Volatility is on the rise and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option. This is, of course, the program aimed at busy financial advisors and planners and asset managers, where we attempt to introduce you to some interesting options concepts that you may want to use in your own financial practice. My name is Mark Longo from theoptionsinsider.com, as well as the Options Insider Radio Network. And I am joined today, as always, on the Advisor's Option program by my co-host, good old Randy Swan, the co-founder of Swan Wealth Advisors. Randy, welcome back to the program.
Mark, glad to be here today.
Yeah, we have a great show. I'm really excited about today's topics. I think we'll just dive right into it.
And now it's time for practical tips on how to implement options into your practice. It's time to learn the tricks of the trade.
All right, and welcome to our Tricks of the Trade segment. This is, of course, the portion of the show where we break down some interesting techniques or strategies for implementing options into your portfolio. And today's segment is actually going to be a little bit different than our traditional Tricks of the Trade segments in the past. This is not going to be a tool or a strategy that you can use to add options to your portfolio or onto your trading system or whatever the case may be. You know, Randy and I were discussing what the topic for today's show should be. We kept coming back to this one fundamental misperception, I suppose you can call it, that is just pervasive in the financial advisor landscape right now. And it is this myth that has popped up around asset allocation and the risk mitigating abilities that it has. You know, I think a lot of us, no matter where you studied finance or business or financial planning, whatever the case may be, a lot of us kind of came into this business with the old capital asset pricing models being drilled into our heads, and the notion that if you had somewhere between 10 and 20 different underlyings in your equity portfolio, you were traditionally considered fully diversified, in quotes, whatever that meant. And if you went a little beyond that, perhaps you were a little bit more aggressive. Maybe you had a mix of fixed income in there, and maybe if you were really doing your due diligence for your clients, you added a small component of something else that was considered to be a good hedge, and that was gold or some other commodity type asset. And if you had all that in your portfolio, you were typically considered to have done your fiduciary obligation for your clients, and that was really where the rubber met the road from a financial advisor perspective. That was the value added that you were bringing to the equation. Now fast forward a number of years later, and of course post 2008, 2009, we're all living through this new market environment. And what we've really seen in this new environment is that it tends to really put the lie to that belief that you could simply fully diversify through simple traditional means of asset allocation. Now, Randy, when you started up your Swan Wealth Advisors back in 1997, so it has been a while, you started around a pretty basic quote that I think is very applicable to what we're talking about here today. So why don't you go ahead and start us off by reading through the quote about asset allocation that you kind of really have built your practice around.
Sure, Mark. The fundamental premise of the DRS strategy or how this concept came into being was I really believed at the time, before all these market events that occurred over the last 15 years, was that asset allocation is not enough. And the fundamental premise of asset allocation historically is that you're supposed to combine different asset classes that are somewhat non-correlated, and that you hope over time that you're going to get your type of return that you like in your portfolio. But most importantly, when one asset class went up, maybe another stayed flat, another one went down. So you really smoothed out your returns. And fundamentally, I always had a problem with that concept because in the absence of some of the techniques that we're going to talk about later in the program, you really can't count on those asset classes to be non-correlated. There's no assurance. You have no reasonable expectation, really, in any type of market dislocation that those fundamental techniques of asset allocation are really going to work. So it's really more or less stated in historical terms, a historical perspective of how certain asset classes performed in the past, and you're hoping those things to work that way in the future. And of course, when you use the word hope in investment, it's really usually probably a negative, that it's not going to work out that way. I think 2008 actually kind of proved that theory to be not true. And of course, we always go back to the definition of market risk cannot be hedged by buying different asset classes. And that's really what we go to, and that's why the program is about really trying to expose other advisors and other individual clients on the proper uses of options to be able to take advantage or to actually fix some of the problems that asset allocation has not been able to do.
Yeah, so if you're the traditional wirehouse type advisor where you're using, the model that they assign to you typically, and you bring in a client and you break them down by their age and their risk tolerance, and then you break them down into what you perceive to be the proper asset allocation for them, some percentage of equity, some percentage of fixed income, maybe a little bit of the extra, like we were talking about before. And that was traditionally conceived to be, or traditionally thought of to be, really your due diligence as an advisor. And also for a lot of the listeners out there who may be looking for advisors who are interested in options, and so they're listening to this program as well. You really want to, and in this environment, you really need to expect more from an advisor. And if you're an advisor out there, you really need to be able to provide more on that service level to really provide that value added anymore. Because, as Randy just outlined and as we discussed today, post 2008, 2009, that really was a wake-up call for a lot of the advisors out there who are traditionally long only in a lot of their equity portfolios. They may have a long, very broad equity portfolio offset by a little bit of fixed income. And what we saw in that time period was just massive downturns, 30, 40, 50% in some cases. And those types of scenarios, you simply can't hedge away through traditional asset allocation. You just can't do it. And what we've also seen post that time period is that what has been the enemy of asset allocation and the traditional model of asset allocation, which is, of course, correlation, has been creeping upward to a very, very alarming rate. In fact, the number one complaint we hear out of advisors these days when they contact us for this program is that just assets are correlated across the board to an alarming degree. And I'm sure you're seeing this as well, Randy, where things that traditionally would have perhaps provided some measure of risk mitigation in the past are now moving, if not in lockstep, to a very alarming close correlation with another underlying you may have in your portfolio. So things that used to be inversely hedged, like perhaps gold or other things, they've all been rallying with the market and vice versa. And so we've seen a lot of these traditional sources of risk mitigation and asset allocation have suddenly become the opposite. They're actually correlating to your underlying portfolio, and that's exactly what you don't want them to be doing. So in this environment, it really has become a difficult prospect to add that risk mitigation. And I'm sure you've been hearing that from a lot of your clients and people you speak with as well, Randy, that just this growing correlation across all assets is really contributing to the death knell of the traditional asset allocation myth.
Absolutely. And then we respond to say, look, asset allocation is a part of the process. We believe, of course, that using options is the final solution, or is a solution that's more complete. I always talk about the advisor's goals when they're looking to hire firms like us to manage money for them, is that a good manager is always trying to find a good advisor is always trying to find money managers out there who he can combine a bunch of different asset classes that are non-correlated. Of course, as you just stated, that's becoming more and more difficult. So at the end of the day, of course, we believe the solution is using more options in the portfolio where you can actually quantify the risk. And that's really, I think, what's important is there's a difference between saying this is the way it theoretically should work out, and using some of the techniques that we'll talk about, this is actually what will most likely happen. Of course, there's no certainties in life, but you can quantify your risk much more using options than you can hoping that asset allocation or correlation coefficients are going to stay, not equal to 1.
Yes, the key takeaway I hope you get, listener, from this conversation we have today is that at the end of the day, if you're looking for some sort of asset to really provide you with true inverse correlation to your portfolio, to provide a true hedging risk mitigation component, you really cannot achieve that in today's market if you don't have some sort of derivative component in your portfolio. And we are going to talk about options today. That's the primary outlet that we're looking at here today, but there are other cases. You could have volatility products, you could have some sort of futures component. But really, in today's market, something that gives you some sort of direct inverse correlation to your underlying, as well as some sort of volatility exposure, is really the only way at the end of the day to achieve what we're talking about here today. You can't simply spread this away across a larger number of asset classes. I thought this message was hitting home, Randy, after the debacle we saw a few years ago in the marketplace. And yet last year, those listeners who may not be familiar, Morningstar has a very large advisor conference they hold every year in Chicago. It's at McCormick Place, an enormous event. I went down there last year for the first time in the summertime to see and kind of get the pulse of the advisor market and to see what they were thinking in terms of these types of issues of how to implement asset allocation, if they were hedging, if they were, how they were doing it. And of course, there were panels and firms there and large funds talking about things like risk mitigation and protecting to the downside. But when you actually would talk to them and drill down what they were talking about, it was typically defensive stock selection and things like that I think I and most of our contributors on this network would consider to be very outdated approaches to risk management. And so that really opened my eyes to the fact that a very large percentage of this business, the very large mainstream money management, financial advisor, asset management community that Morningstar serves, hasn't really woken up to this fact yet, even after 08, 09, and into early 2010, that you can still have a 30-40% down year and not have any sort of hedging implement to discuss that. In fact, I sat in on a panel, not to beat up on the Morningstar, but to really just to show what the mindset is in that mainstream advisor community. I sat in on a panel that was about this exact topic. It was about the growing correlation among asset classes and how to prevent that and how to mitigate that through traditional asset allocation. And what they hit upon the panel was that the old ways of doing things, the old ways of diversifying across 20 plus assets, correlation had rendered that relatively inefficient. So now if you wanted to pursue that, you really need to have 40 or more different equities or underlyings in your portfolio to consider yourself truly diversified. And when I heard that, I kind of just shook my head and said, you're really just chasing a fool's errand at that point. If you think adding more and more into your portfolio is somehow the answer without having some sort of direct correlation type product like a simple put or a put spread or some of the other things we've hit on this show many times in the past. But I'm not sure if you've ever been to that event, Randy, but it kind of is the Super Bowl for the advisor community to really see what everyone's talking about. And that I came away from that kind of dismayed and also a little bit alarmed that what happened in '09 could really happen again tomorrow. There hasn't been a lot of learning from that in that broad advisor community, and also that they're not really embracing these techniques that we've discussed here on this show many times. And that probably doesn't come as a surprise to you, but seeing it in person like that really, I think, opened my eyes to the need to do things like get this program out there to more people, and B, that this community really needs to wake up to what we're talking about here today.
Well, it is relative, though. That's the most important thing. Just going back 5 years ago compared to before 2008, it's gotten much better. I think it's gotten better over time, but it is going to be a long process. It's going to last long, decades probably to get to this point. And quite frankly, we will probably need another 2008, 2009 scenario to hit the point home again. It's almost, the analogy would be someone going out to the beach and going in and saying, yes, come in the water, feels really good. We probably need some more events like that. But I am actually encouraged by the things that I've seen recently. Actually, I was up in Chicago at a different event recently, and there were other firms just at the place that I was presenting our strategy at did actually have some other options, some other firms that were doing some option strategies. So I think it's getting better, definitely.
Well, I'm glad to hear you're more optimistic than I am. Maybe that's just my deeply cynical nature, Randy. I don't know, but I came away from that a little bit dismayed. But let's hit on some of the traditional stumbling blocks that a lot of the advisors will encounter when they're thinking about doing what we're talking about here on the show. One of the traditional hurdles people have thrown back at us when we said, hey, you have a long equity portfolio. You should really hedge this with a protective put position. That should be a no-brainer to you. And one of the traditional pushbacks we've received on this, and I'm sure you heard this all the time as well, Randy, is, that's too expensive. I looked into hedging my tail risk. I've looked into, let's say, downside S&P puts for my broader portfolio, or individual name puts for my Apple portfolio, or whatever the case may be. And that's just too much money. It's too much of my returns, too many basis points being siphoned away to hedge a position that I already think I have more upside in anyway. So it's kind of just throwing money away. And Randy, I know you have a response for people when you hear that sort of thing. What do you tell people when they come back at you with that? Buying downside protection is simply too expensive.
Well, I guess I would look at it on two levels. If you just look at it on the level of comparing one asset class, let's say long exposure to the equity market versus hedging that or not hedging that, our experience over our 15, 16 years, quite frankly, is just the opposite, that there hasn't been this huge cost over that time period. We've actually done fairly well of nearly matching the market in those type of environments. And of course, having that downside protection is always comforting, knowing that you're not going to lose a substantial amount of your money if the market, quote, doesn't come back the next time. So that I would challenge that. I would look at it secondarily and say the whole goal of portfolios in my mind is to have a return that you get over time, but that you can smooth out those returns. So hedging, even if you give away some on the upside in the bull market years, it's really, the question is that what do you make at the end of the day after some of the bear markets are factored into that equation? So, we get into this, I think we're going to talk about this a little later, is I've seen some research done saying that you only need about 30% of the upside to beat the buy and hold investor when you take into account the bear markets. So in finance, you talk about standard deviation, right? Getting a 4 or 5, let's say a 5% return on the equities over the last 15 plus years. If you were able to get it where the standard deviation was significantly lower by hedging it, that's a better return, and according to finance rules. And then I think the second way to evaluate is you can't just look at the strategy and how it performs in isolation. You would have to say designing a portfolio that has things like protective puts in that portfolio, really looking at it more of a portfolio view as what's the total return or the expected return of that portfolio. I know that most pension plans historically have had 7 to 7.5% returns in their portfolios when most people are focused on a 10% return on stocks. Well, if you can do the same thing in a portfolio and still get that 7%, but you've got a lower standard deviation, that's better, and that is a portfolio view. That makes sense.
I think it's interesting that a lot of people, for whatever reason, even in this modern market environment where we have a lot of evidence to the contrary, a lot of people still think of returns as just, your positive upside returns, and if you're outperforming the market, you're beating it to the upside. But outperforming to the downside can often be substantially more impactful to a portfolio. If you only had a, let's say, 5% down year in '08 or '09 when everyone else had 35 or 40 or even 50%, you substantially outperformed everyone else, and you're also in a much better position the next year to turn around and rebound than those other portfolios that have to remake pretty much double their assets to get back to where they were. So people tend not to factor that into their equation for whatever reason. Perhaps it's not as sexy when you're selling it to a client that, oh, I outperformed at the downside. But that is an overall driver in your overall long-term returns. If you're outperforming to the downside as well as to the upside, that means your long-term returns are dramatically going to outperform. And as you just said, we had that great quote. I believe you pulled it from, let me see where we can attribute that quote to. I had it up here before. 1 second. Oh, yes. You pulled that from, I think you pronounced that John Nairati. He wrote a book, How to Outsmart the Market Using Sector Rotation and ETFs. And he said, if you don't lose money during downturns, you only have to capture roughly 30% of the upside move of a bull market to beat those buy and hold investors out there. I think that's a great point to hit on, because in reality, if you can accomplish what we're talking about here with a minimum of outlay and be able to contribute to outperforming to the downside, that opens up a lot more doors to you as a financial advisor and as an investor.
Well, Mark, and my point also would be that I love the concept of what you talked about is when you don't lose a bunch of money on the way down, when the market sells off, you don't need as much money to get back to square one or a yearly outperform. I think that is the math and the science of how you beat the markets over time. When people come ask me about that, I say, look, I always underperform on the upside, but guess what? What you really are hiring me to do is to outperform on the long term. And the only way I know how to do that, absent some guy that knows how to time the market or predict stocks, is really the downside protection. That's how my firm is able to do well, is to actually beat on the downside. And so it just gets back to the concept of, I think most people out there kind of assume that timing the market and picking stocks has been kind of debunked as it's very hard to do over an extended period of time. Well, our firm focuses solely on the downside protection for the most part. So that's how we believe the value is added to potential advisors is helping on that downside protection. That's the way you ultimately win the game or beat the market over the long term.
Yes, and I would just add this one thing for a lot of our listeners out there who still think, for whatever reason, that sort of protection, buying puts and things like that, is dramatically overpriced. I would just point you to a couple of things. First off, we did an excellent program a few weeks back, our Volatility Views program. And if you like what we're talking about here, I recommend you check out that program. Randy has been a guest on that program in the past. We get into the world of volatility and how it inversely correlates to the underlying markets and how you can use that in your trading. But I think if there's one asset a lot of people would point to as saying, oh, that's very, very overpriced because it has all that tail risk and black swan risk built into it, it is the very near term, very near out of the money S&P downside put. And yet we had a guest recently who looked at that type of put. And of course, this is recent history. So this is, of course, over the last quarter or so as the market has generally been in bull market mode. But even those puts, those very near term front month S&P downside puts, have held their value surprisingly well for a number of different reasons. People flocking into those as a result of trying to hedge against the bear market and all those sorts of other inflated premiums we've talked about in the past that have kept those puts holding their value relatively well. So even though you're paying a surprisingly large level of premium for those puts, and they are what a lot of people point to as being the overpriced source of protection, even those have performed surprisingly well in recent market environments. So it's difficult to really hold to that notion that this type of protection is overpriced, particularly compared to what you're getting. And if you're looking for ways to structure that protection in perhaps a more cost-effective way, go back to some of our earlier episodes where we discussed positions like protective puts and collars and how you can structure them in an appropriate way to really maximize their impact for your portfolio and maximize the bang for your hedging buck. Now, the next thing we hear from a lot of people who pushed back against embracing some of the strategies we're talking about here, and they instead return to traditional asset allocation techniques, is that, oh, well, if I'm looking at your defensive type strategies or using options in some sort of protective or hedging capacity, I'm going to underperform the buy and hold or my traditional long only strategies as a whole. And so there actually has been a lot of great research on that in recent years, pointing to different strategies that a lot of advisors like to embrace. And we talked about it on a recent show, actually, called The Collar. And if you don't know what a collar is, I encourage you to go back a few episodes, download that episode where we discussed the collar at great length. And if you don't know what a collar is, I encourage you to go back and check out that episode because we go into the collar in great detail there. That is perhaps if not one of the most popular options positions that a lot of advisors utilize. And what the OIC, the Options Industry Council, of course, who are usually on this program with us here, they're not here today, but they've done a lot of great research into the overall performance of that strategy in a variety of market environments. Remember, the collar is buying a protective put and offsetting some, if not all, of that cost of that put with a covered call to the upside against a long equity position. And what they found, they've studied it over a lot of different time periods in both the Russell and the Qs and a variety of other indices, is that first off, as Randy mentioned before, when you're looking at a risk-adjusted basis, pure standard deviation, pure return for your risk, the collar dramatically outperformed the simple buy and hold long only strategy by orders of magnitude. And now, but what's really interesting, I think what opened a lot of people's eyes to this, and what really I think should hopefully bring some of the naysayers who are listening to this program saying, well, asset allocation is superior, is that the collar outperformed, well, let's say, I won't say outperformed, it was very competitive, and in some scenarios did outperform the buy and hold on a total return basis as well. And that's what really surprised me. Because even on those periods when it was a dramatic bull market, the collar didn't underperform as dramatically as you might think. And overall, because it had that much better downside profile, the collar outperformed dramatically in most scenarios, just buy and hold outright. Now, Randy, have you had a chance to look at any of those studies? I'm sure they probably just fall in line with what you've seen over the past 15 years at Swan as well, that even these types of strategies that are defensive not only outperform on a risk-adjusted basis, but can also be very competitive on a total return basis.
Absolutely. I've read all those studies. I agree with them all. Our strategy is slightly different than a collar-in strategy, but generally speaking, we've had very good experience with those types of techniques and strategies, and we believe they're very important, especially in today's not only the risk levels that I think are out there right now with the markets, but also the fixed income environment where a big portion of everyone's portfolio, quite frankly, has, in my humble opinion, a very small probability of ever succeeding when interest rates are so low. So, I think that just makes it more the issues that I think are coming makes it more compelling to do these types of things. I think I go back to the same thing. In an environment where you think that we're in a bull market environment and you say the market's going to go up, let's say 10% a year for 3 years, and then year 4 you're going to have a bear market, I think that you're going to close up a lot of that gap. Can we quantify that's going to certainly work out every single time? No, but I think on a risk-adjusted basis, it's going to be a good strategy for everyone, and sometimes you may actually outperform the market if the sell-off is large enough.
Now, I know you don't replicate what the OIC does in their collar strategy over there at Swan, but you take a similar approach. You have downside protection, you offset it with income generation to the upside, so it is in many ways analogous. And you've seen a fairly decent amount of participation to the upside over there at Swan over the past 15 years, while also dramatically clipping that downside tail we're talking about. And that's kind of really what we're all after here at the end of the day, right? Is that we want to really cut the downside and still participate on some, if not most, and hopefully all of the upside on a lot of these portfolios. And that's kind of what you guys have been able to work out over there at Swan, right?
That's correct. We historically have had about 70% of the upside and only 5% of the downside. So going back to that 30% rule that you mentioned, the quote earlier in the program, that's consistent with our historic long-term performance. And that is obviously our goal is that we know over time, if those ratios are maintained over time, you should have no problem outperforming the market over an entire market cycle. And of course, I think that's the kind of that's the goal of every money manager, is not necessarily outperforming in the good years, but actually over an entire investment cycle, which sometimes it's hard to get clients to focus on that. But we think that's the true way you provide value to your clients over time.
Yeah, and those returns you've been able to generate, and we highlight this not simply to promote Randy and Swan, but really to get to the heart of what you can do using options in any types of portfolios you may have for your clients. Is that, you guys are able to do that over there at Swan. When you're doing all these things that a lot of these advisors would traditionally consider to be wasting money, like buying these puts and buying put spreads and spending all these basis points and allocating a lot of your percentage of your returns to traditional hedging components, and even spending money on these things that a lot of these advisors who push back against this might consider wasteful, you're still able to use those premiums. And of course, we've debunked the wasteful thing, but some people still believe that, and so we'll let them have their beliefs. This is a very open and free forum here on the advisor's option. But even doing these things that those people would classify as wasteful, you're able to generate these types of returns and also limit your downside exposure doing that. So I think that should be an eye-opening thing to a lot of advisors out there who are still sitting there with the traditional spreadsheet and your 60, 30, 10 or whatever kind of makeup you have and say, wait a minute, I really need to be doing a little bit extra for my clients here. Wouldn't you agree, Randy?
Absolutely. I think the only really issue that you come down to is that it comes down to when you are evaluating the strategy, the hedging strategy that you're trying to employ. So clearly in years like 2008 and 2009, even 2002, buying protective puts is a no-brainer. It was a great strategy. It's always coming up with a strategy, I think, in the very end that has enough offsetting components like income-generating components that allows you to stay in the game and keep as much of that upside as you can in the bull market years.
So I think really the key takeaway from this discussion today, and in fact from every episode of the advisor's option, whether you're a busy advisor listening to the show to learn how to implement these strategies, or if you're a listener who's looking for a financial advisor and you want to learn more about what your advisor should be bringing to the table, I think the key takeaway for both groups of listeners really is that in this market environment where everything is very highly correlated, you simply cannot diversify risk away or mitigate risk through the old techniques. They are insufficient. They are not up to the task right now. So if you sit down and you are an advisor who is doing this, or if you are someone who is looking and meeting with advisors and they're showing you this and they're sitting you down in the old traditional manner of here's your age, here's your risk tolerance, here's your other things, okay, here's this what your asset allocation should be, and it's primarily a mix of long-only equities with perhaps some fixed income and a little bit perhaps on the side of commodity or something else, that really is insufficient. That's not up to your fiduciary obligation as an advisor in this environment. You really need to, in order to mitigate risk effectively, embrace the techniques that we've been talking about here on the show for quite a while. And again, we've hit on many times on the show, you don't have to be elaborate. You don't have to be an options master to utilize these techniques and dramatically increase your risk, your rate of return for your risk, lower your overall volatility of your portfolio. Just doing simple things like buying protective puts, perhaps using put spreads, and getting into some of the more elaborate positions down the road, like collars, like a lot of advisors love to use these days. And using those very simple strategies can go a long way toward A, reducing the overall volatility of your portfolio, B, very importantly, reducing the downside risk of your portfolio. And in these market environments where most indices are reaching all-time highs on a daily basis, it seems, you certainly want to have an eye on the downside in this environment. And those types of scenarios, these types of portfolios, these types of positions can dramatically outperform. And so when you combine those two things, it really is almost a violation, I think, in this day and age of an advisor's fiduciary obligation not to have at least some sort of hedging component in their portfolio with either a protective put, an option, some sort of derivative component that can offset a lot of these risk factors that we're talking about today. Randy, what do you want to say here in conclusion for our listeners before we wrap up this topic and dive on into the mailbag?
I would just say that any advisor or any individual investors that are interested in using options should do their due diligence, start out down the road to look into this. It's a very viable. Of course, we're biased to some degree, but we think it's a great way to complement your other portfolio stuff, and they should not give up until they find advisors or managers that can help them out. Despite whether or not other people in the industry still rely on the old tools of risk management.
And of course, you're right, Randy. We are preaching from the choir. We are very deep into the options Kool-Aid, so to speak. So we are somewhat biased, but yet, looking at these returns in any sort of objective fashion, looking at the math behind it, looking at the asset allocation models that people have been running in this environment, it is clear that you really cannot achieve your risk mitigation goals using the old ways. You really have to add these components that we've been talking about a number of times here on the advisor's option. All right, that's it. We're going to get off our soapbox now and keep on rolling into our next segment. Of course, one of our favorite segments of the show. This is where you guys get your chance to ask us your questions and make your voices heard on the show. Of course, this is the listener mailbag.
Listener mail. Listeners write in.
Mailbox.
All right, and welcome to the old mailbag. And this is, of course, the portion of the program where you, the listener, gets your chance to weigh in. And we love hearing from you guys out there, all you different advisors who are listening to this show and want to know more about the different strategies and topics we're discussing here. Or sometimes people who are just regular retail listeners who are writing in, asking questions about finding advisors and choosing advisors. We love interacting with all of you. So if you have a chance to, or if you have a question for us here on the show you'd like to hear answered, then by all means, find us on theoptionsinsider.com. You can post a comment. You can shoot us a question directly to questions@theoptionsinsider.com. Just make sure you put question for the advisor's option in the subject line so we know which show you're referring to. Of course, you can find us on Twitter or Facebook. A lot of great ways to get in touch with us here on the show and make your voices heard. And speaking of making your voice heard, the first question comes in from an advisor who wants to remain anonymous. I can certainly understand that. So we'll just say Mr. Anonymous writes in and asks, as an active financial manager coming to options for the first time, I'd like to know what the hosts consider to be the most effective options position for busy advisors. If I only have time to learn one, I'd like it to be the best. And so, Randy, I'll take this one first, give you some time to ponder it over there. But, this is an interesting question. We get some variation on this question all the time on this program. And, it's difficult to come up with one overall position because we've discussed so many interesting things that advisors should be aware of. And I would certainly counsel you, if you're interested in adding options to your clients' portfolios in any way, shape, or form, you really become conversant with a wide variety of option strategies and how they perform in a variety of market conditions so you can more fully and effectively service your clients. But that being said, the question is, what is the one quote-unquote home run type position for advisors? And I'd have to come back to what we were discussing earlier. It really seems to be, for the vast majority of advisors out there, the collar seems to be the most appropriate, the most applicable options position for them. Most of these guys are traditionally long-only equity managers, so they're looking for two things. They're looking for offsetting downside risk, which we just talked about in the earlier segment. So they want to outperform to the downside, and they also don't want to pay a lot for that protection, if anything. So they write upside out of the money calls, sometimes in the money calls, depending on how they structure their portfolio. They write these calls against it, and they're able to offset some, if not all, of the premium that they're paying for that position. So what they end up with is a hedged equity position that they can show to their clients and say, we're not going to lose more than X amount on this position. And, the pushback to that is always, well, your upside is clipped. But, that's a conversation we've had time and again with a lot of different advisors, that really to educate them that that's a good thing. You want your position to be called away. You want your stock to be called away. You want that rally to happen because you can always write the call again. You can always establish a position again. And yet to the downside, you have a lot of other issues to deal with. But to the upside, for whatever reason, there still is this belief among a lot of advisors that, getting called away is a scary thing and I don't want to do that. But in reality, that's your position is working. And that's something you can repeat. If you can write a call and have it called away every month, you're doing very well. So I would say if I had to weigh in on one position, it's kind of a cheat because it's actually two positions. It's a protective put and a covered call. But if I had to weigh in on one position/strategy that seems to offer the most benefit for the broadest array of advisors, I would have to come down on the collar. Randy, what say you to our friend Mr. Anonymous here?
My answer would be, if there was one strategy to implement and the advisor had a limited amount of time to do it, I would actually use a put spread. And I think a put spread would encompass some of the concepts of downside protection, but it also, I think it's fairly easy to implement, and it's something that someone's not going to have to watch on a daily basis. And it does take into account some of the components to lower the cost of the put option. As long as you can live with the risk above a certain level, below a certain level, if the market or the stock drops below that level, I think that would be a great strategy.
Well, there you go, Mr. Anonymous. Two different but related takes on the same question. Of course, the put spread also allows you to offset some of the price you're paying for that put, which is, of course, the largest single obstacle most advisors have to actually buying a protective put, is that it's too expensive. So the put spread addresses some of that. Of course, it clips some of your downside protection as well, so you need to be aware of that when you're going into those positions. If you're expecting some sort of apocalyptic, quote-unquote, black swan event, put spread may not be for you, but if you're looking to hedge some very near-term, very mild downside swings in your portfolio, put spread is certainly a great position for you and a great way to do that and a great cost-effective way to get some of that downside protection we've been talking about. All right, next up in the old mailbag, we have a question from Mr. Tom Meadows. Reaches out to us from good old Pittsburgh, Pennsylvania. And he asks, what percentage of financial advisors and planners do you estimate currently use options? And Randy, I'm going to throw you into the hot seat on this one and let you go first. What do you think here for your percentage for Mr. Tom Meadows?
Of course, I have no way of knowing that, but if I had to guess, it'd be less than 10% of all the advisors out there that use managers or use options in their practice. It's just because this is such a new concept to most advisors. We've talked about this in the past, but I can't imagine more than 10%.
You know, I tend to fall in that, I guess you can call it somewhat cynical realm as well, that it is a substantially low percentage of overall advisors and total advisors actually use this. OIC has done some studies to this effect in the past. I think they released the first quantitative study of advisors and their use of options a few years back, and it had a bit of a higher number in there. And that kind of struck me as being a little bit odd, just because there might have been some selection bias in there. I don't know. At the end of the day, it still is hard to track down all these different advisors and find the ones who use options and find the ones who don't, and break down their overall allocations. So that might have been some of the issues with that initial study. But they might come to us with a different and perhaps higher number. But I think when you look at the overall spectrum of all the advisors and people who fall under that rubric of advisor planners and whatnot, who are working in all these different towns and cities across the country, how many of them are actually implementing options? Yeah, I definitely agree with you, Randy. It's south of 10. I wouldn't be surprised to see south of 5%, which is a shocking thing, really, because we're talking about very basic strategies here that I almost am amazed that you can get a certification this day and age and not be required to have at least some sort of protective put or other type of strategy to mitigate your downside risk. But c'est la vie. I'm perhaps a little bit, I've drank the Kool-Aid, I suppose. And this next question actually gets into that exact thing. So we'll keep on rolling with our final question here in the old mailbag. It is from Alan Gregory, writing to us out of scenic and lovely San Diego, California. I was just there a few weeks ago. It certainly is beautiful. Makes me pine for the days of perhaps the West Coast branch of the Options Insider, located out of scenic and sunny San Diego, California. Mr. Gregory writes, if options education for financial advisors is such a problem, why doesn't the OIC or some other options entity offer a certification course for planners and advisors? And of course, it's just Randy and I on the show today, so our friends from OIC, Eric and Alan, are not here, so I'm leery to put words in their mouth. I will just speak from my own perception on this issue and perhaps let them address this again when they come on the show down the road. But from what I've seen of this, because I've asked that same question, I mean, if there's any entity in the options world that is well suited to this task, it is the OIC and their parent company, the Options Clearing Corporation. They are a member-owned entity of all the different exchanges in the options world, so there is already that membership component. They are already a very much broad industry-focused arm, and they're very reputable within the space. So they are a much better choice than perhaps some individual exchange like the CBOE doing that, because people might then question, oh, they're promoting their own products or things like that. When you have a joint industry venture like the OIC or the OCC doing this, it really does lend that veneer of impartiality, which is required for something like this. And yet, they've gone down that road a few times, I think, and investigated this. And at the end of the day, I think what's happened, particularly post-Madoff, is there has been pushback from some of the member exchanges regarding the liability. They don't want to go out there and certify a planner or someone and saying, hey, this person is certified in options. That person then proceeds to go out and do some overly risky strategy like write straddles or buy straddles or write downside puts or whatever the case may be on someone who is not particularly suited to that strategy, and they lose a lot of money, and then that comes back to the options industry in some way, shape, or form. And they say, well, you certified this person, I'm now going to sue you. So that liability fear, unfortunately, is very pervasive in the options industry right now. Of course, we're living in an era of Dodd-Frank, post-08-09, where we're really seeing a lot of regulatory crackdowns in this space. So I think the combination of liability concerns and the intense regulatory scrutiny on the derivatives markets right now are really going to keep that on the back burner, which is actually unfortunate. I think if in this environment, this actually should be pushed to the fore. You'd think Congress and the regulators would really want this to go out there and add additional education on these products so that the vast majority of the public could have more access to them. But unfortunately, that is not the case. So unfortunately, Mr. Gregory, that's my take on it anyway. I don't think we're going to be seeing OIC going down this road anytime soon, even though I think they would be ideally suited to the task. Randy, anything you want to add here on this topic for Mr. Gregory?
No, I would just agree with what you said. You probably have a better perspective than I do. I would like to maybe go back and add one comment on the prior question. We both agree it's such a small number, and the reason why I think it really is because our firm is constantly trying to deal with other advisors coming to us and want to use their platforms, and when we go to most of these platforms, the overwhelming response the overwhelming response is we either don't have the technology to allow you to do your strategy, or we don't even want you to use options. So the anecdotal evidence is definitely out there that it's a very small percentage of firms that will even let you do it on more of an institutional or money management platform.
Yes, when we're talking about anecdotal evidence, I love to bring up this example. This is what really opened my eyes to this problem to begin with. It's a little bit of a dated example now. It's probably about 7 or 8 years ago, but I think the percentages are still somewhere in line with what they were back then. I was contacted by a major financial publication at the time, and they asked me, could you write up a very large feature piece for us about financial planning? This is prior to the website. I was still trading. I was still doing some columns for different publications on the side, and they wanted to really dive deep into this realm of financial planners and advisors and how they use options. So I said to them, okay, sure. Sounds like an interesting topic. I'd never delved into this before. This is probably around 2005, I would say. And I said, give me the names of some advisors who use options, and I will reach out to them and we'll discuss what they do, and I'll analyze it and we'll write something up about it. So they went out. They couldn't give me any names, first off. So then they went out to all of the two major nationwide organizations that represent most of the planners and advisors in the country. They reached out to their membership and said, hey, if we're looking to do this article, if you use these products, contact us and we're going to write about you in this piece. And so planners and advisors, not being people who are shy of publicity, I thought we'd be overwhelmed by responses. And we got a total of about 3 responses, I think, from both major nationwide organizations. And of the 3 responses, only one of them would I consider even remotely interesting enough to discuss. So that to me was my first real anecdotal experience with the lack of penetration in this space. The problem has been, that percentage has grown somewhat since then, primarily because of the efforts of people like the OIC who are really going out there and pushing this agenda to advisors across the board. But still, anecdotally, I have to agree with you, Randy, I haven't seen that much uptick in the advisor space. I'm sure if I went back and did that now, I would get more responses. You guys would certainly be in that mix now over at Swan. But, in reality, there wouldn't be many more, unfortunately. And that's still the reality of the advisor realm, for better or for worse. All right, and on that unfortunately dour note, I'm going to wrap up the mailbag, and that's also all the time we have for this episode of The Advisor's Option. But before we go, Randy, I always like to check in with my co-hosts and see what they're up to in their neck of the woods that may interest our listeners, any particular projects or developments or appearances that may have coming up that may interest our listeners. And since you're the only co-host we have today, you get all the spotlight to yourself, sir. So what is coming up over in the land of Swan Wealth Advisors that may interest our listening audience?
Well, we're going to participate in 2 conferences coming up. One is the Mid-American Conference and the Persian Conference in Florida next month. I'm speaking at a couple private events for some of our advisor clients. That's really a big part of my role at this point, is just to go out and support and speaking in front of their clientele.
And if they want to learn more about where they can attend these appearances, can they find it on the Swan Wealth Advisors website?
Absolutely. They can find all our upcoming events on our website, as well as some of the articles and discussions that we've talked about during this program. Most of that material is on our website.
Of course, that's just swanwealthadvisors.com, or of course, you can always just surf on over to the landing page for this program on theoptionsinsider.com. I'm sure which many of you are listening to it right now, and just click on the Swan logo or the Swan name there, and they'll take you right to the website as well. So a lot of different ways for you to get over to the website and check out what the guys at Swan have cooking that may interest you, the listener. And speaking of things that may interest you, if you're one of the more active advisors in our audience who likes to use options and you're interested about some of the things we talk about quite a bit on the optionsinsider.com as well as on this radio network, I'm referring, of course, to unusual options activity, then we may have something that may interest you over here at the Options Insider. We're launching our new events division, and to kick it off in grand style, we're doing it on a topic that I really haven't seen an event on before, and that is unusual options activity. We're going to dive really deep into that, how to find it, how to analyze it, how to separate the wheat from the chaff in terms of actionable activity versus things that are relatively useless. And then once you have that information, how to trade from it, how to incorporate it into your portfolio. We're going to really dive deep into that. That event's going to be May 15th at the CBOE, at the Chicago Board Options Exchange. Unfortunately, for this event, it's only going to be in Chicago. You have to be there to attend it. We can't webcast it just because of the location we're at. But if you're going to be in Chicago on May 15th, we'd really love to see you down there. We have a great array of speakers on this topic. You're going to throw in a tour of the exchange, so if you haven't had a chance to go down there and see where some of your favorite products like SPX or VIX or Apple or Google trade, take advantage of this because that floor tour is not going to be offered probably a few years from now. So take advantage of this. Of course, a lot of other great freebies you'll get for signing up for this course. And in addition to all the great material we're going to be talking about, you can surf on over to theoptionsinsider.com/events for more information on our unusual activity forum coming up on May 15th in Chicago. We'd really love to see you there. And on behalf of Randy and myself, and of course Eric and Alan, who couldn't make it here today, we want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and of course for writing in with such great questions. Please keep it up, and we'll see you next time right here on The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.